Hi, my name is Amy. Thank you very much for watching, and let's make some bad financial decisions together. This is for entertainment purposes only, so if you're entertained, please like and subscribe. I would really appreciate that. Today we're going to be talking about YMAX and YieldMax, but first I'd like to let you know that I am the owner and creator of YieldMight.com, and I do receive ad revenue from that website, and this video is not sponsored. And the first thing we're going to talk about today is YMAX and the rebalance that they did. They announced this a while ago, and the way that I read the prospectus and what happened is a little bit different. But basically, what they had was all of the single stock tickers before. These are what they took out for now. This is what they've added for now, and what they've added is Chippy, RDTY, which is the Russell 2000, Renty, which is their REITs target 15, SOXY, which is their target 15 AI focused. And then, so we have Chippy and SOXY, which are both semiconductors. And together you'd have more price appreciation with SOXY than Chippy, but Chippy has more yield. So you're going to get middling yield, middling price appreciation. And then we have Ulti. And so post rebalance, the current holdings in the portfolio are ABNY, Airbnb, the Apple one, Berkshire Hathaway, Chippy, which is the semiconductor ETF, Circle, GDXY, which is the gold one, JP Morgan, Moderna, which after spending so much time making fun of it, it's really good to see it turn around. So Roblox, RDTY, which I already said was the Russell 2000, Renty, SMCY, SOXY, thank you so much, and Ulti and Zomo. So I thought they were going to keep all the single stock ETFs, just make them a very, very small portion of the portfolio because they don't have to weight these exactly the same anymore. And if they're going to only rebalance once a quarter, the only thing that I'm cautious about is what if, Google has a good, some good momentum and we lose a month or two of the momentum before we add it back into YMAX. But for the most part, just getting rid of a lot of the dead weight and things that are just having a moment for the moment is good. And when we're in a risk on environment, they can always add them back. So I like that this has REITs. I like this has Ulti, because Ulti's been doing on a total returns basis pretty well. So if we could put it into a fund that actually has price appreciation, I think everybody will be happier. So I bought back into YMAX on Friday. So, but not a lot. It's like 10 shares. So I'll keep track of this. I don't feel the need to buy back into Ulti because Ulti's in YMAX. And I think the amount of Ulti that I should have is probably the amount that is in YMAX anyway. Like, I don't need to overweight myself into Ulti. So we'll see how this goes, and we'll see if this actually helps with the price stabilization of YMAX. And, this is not an easy market to be trying new things and to see how well things do in a good market. But, it's really good to see how things perform in the sideways in a down market. So this is a growth chart. I just wanted to see how things were doing yesterday. And so SPY was up 0.4, YMAX was down 0.29%, but Ulti was down almost 2%. So at least it's down less than Ulti. And if you had been in YMAX, Ulti, and SPY since a year ago, SPY is the only one that you would have more money than in total returns. So just putting that out there, that just because you get the higher yields doesn't mean that you're going to wind up with more money. I mean, hopefully, but the changes that they've made with Ulti and YMAX, maybe in a 5-year chart, you would have more money with Ulti and YMAX. It's just that for this particular 1-year chart, you would not have won. You would have been better off just getting that 11% return with SPY. But for the 1-day chart here, so this is from March 3rd until March 4th. So for YMAX, you would have $10,139, which is the most. The second one would be SPY, which is $10,063. And then your worst choice would be Ulti with $9,935. But just don't get too frustrated with these risk-on assets because we're not in a risk-on market. So either buy in and accept temporary losses because we are expecting, or at least eventually there will be a breakout and a bull run, and hopefully the tide raises all ships type situation. So eventually the total return would be much greater. But I don't think buying the dip works very well with Ulti, at least not in the past, because it doesn't capture the upside. It chooses to just capture more yield. And so you don't get the upside reflected in the NAV. And so it's difficult to get into Ulti in a bad market. Ulti is like we have a month of momentum and we think that we're expecting it to go on for another 3 or 4 months and everything's good. But we'll see. They've made a lot of changes to Ulti, and I've kept an open mind with Ulti for a long time, but I'm really hoping that YMAX, with them, having the gold and the real estate market, and the ultra high things that's really flexible, so they can always change the constituents in Ulti. And then Berkshire Hathaway is now a bigger portion of it because they just don't have a lot of the things that are not doing well at the moment. So hopefully by having slightly less, but things that have positive momentum, but it's also not just 5, that YMAX has figured out the formula that will help it thrive in the long term. So I'm going to go ahead. I'm going to thank the members. But something I wanted to do was I had an appointment yesterday and I wasn't able to go to the Wolf trading space, but I think I have questions about YMAX and I think their team may have answered some of them. So this video might wind up being an hour long, but I'm going to be kind of respectful of your all time and, we'll end the video like it normally does and then I'll just continue it as like a bonus video. And so thank you so much, Nikita, Christian, Paul, Lil K, Brian, David, Joey, Shane, Steady Money Lab, Lori Gibbs, and Gibbs, Michael Holiday, BGP Automotive, Opinion Mind, Jetta, and Omega World X. And you all are amazing and you really help make this channel and doing YieldMight more sustainable. I really do appreciate you all. And my question for you all for today is, do you like these changes with YMAX and are you still invested with them? And so the appointment I had yesterday was, remember that time that I tried to do a push-up and then my dog lunged into my hand, which then drove my fingernail into my eye? And then I had to go to an eye doctor, and I scratched my cornea. And well, I had gone a couple weeks ago for the follow-up appointment, and it was kind of follow-up for that and also my regular eye exam. And I was joking with the doctor how I just turned 40 and it was time for my body to betray me. And she said, "Bless your heart." And then she looked in my eye and she said, "Yeah, you're going to need surgery for that." So I went to my appointment yesterday to see a specialist to confirm that I do in fact need a surgery, and I do need a surgery. So I'm going to be down for site maintenance in mid-April. I'll let you all know when. And even though the doctor said I should be be able to go back to work relatively soon, there could be some changes to my vision temporarily. So I'm going to pre-record for like a week and just let myself rest and hopefully like not affect any of my vision. But yeah, it's kind of scary to be like, oh, your retina is detaching, so we need to fix that. So we'll get that. I'm not symptomatic at the moment, so it's not an emergency, but we're doing it with, it's not an emergency, but it's also, I can't wait too long to fix it. So mid-April is when we're gonna get that fixed. Anyways, I want to listen to this because yesterday my eyes were dilated and I couldn't see my phone screen. And I actually wound up, like, I went for lunch afterwards. I went to an art museum to rest my eyes. I spent like 4 hours in town just trying to get my vision to the point where I could drive home. And then even when I drove home, all of the light and the glares bothered me so much. I had to go to bed last night. Like, it was a big headache. I had a big headache, strained my eyes. So I did not listen to this, but I think hopefully they do answer some of my questions and I can pause this at any point and give my own commentary. So this isn't what I normally do, but I am curious and I don't want to listen to this by myself and then come back to you all. But anyways, thank you all for watching, and here we go. Also, I think this is where it starts. They kind of do trading and then they let the YieldMax team on here and then they stop right away so they can do live streaming on YouTube. So like the last hour of this at least should be them talking to the YieldMax team. I love sitting in silence with you all. Yeah, it's really very, very disconcerting when, like, because usually when your eyes are oh, wait. Okay. Like, when I was younger and my eyes were dilated, it would just be like, oh, the lights have a little bit of bleed through, I guess you could call it.
But then, SPY is going to go for that high now. If I hit that 5-minute 9, it instantly just bounced 70 cents.
Really flat to lower for the month.
Where do we go? Right. It's tough. We've hit a big target coming into a slow hour. It's tough to kind of tell where this thing wants to go next. So just be careful. We're going to lead into a fun conversation, and then we'll be on stream rest of the day, as always. Ryan's been over there. He's probably been trading great this morning with some big moves. I didn't even look at IB this morning. Totally forgot about that, but I'm sure it played. Yeah, it played out. 10:30, right into 10:30 we made.
But yeah, because for some reason we're listening to this and I'm letting it interrupt me, but yeah, like it's kind of like a white film over my eyes, and like when I was looking at my phone yesterday, like half the screen just like didn't have text on it. So I just had to wait until I could see out of both eyes before I could drive home. There was nothing else to do. But I didn't notice yesterday that my winter had actually sold because it hit the price target that I had given it. So I'm not going to make enough money this week to cover my expenses, but I reinvested that money this morning into things that won't swing as wildly, hopefully. So what I'm saying is, let's listen to this.
Did we take the high right there? No, we made the high, the IB high, on that 10:30 candle.
We're getting to it.
and then rejected, came back down, held this range, and then finally took it out. So I'm sure he played that move. Awesome. That data is just ridiculous. Over and over it plays out. Love to see it.
Oh, what is this doing? That's not what I wanted to do. Maybe I just don't need to listen to the intro.
I can just not get in those obvious, clear entries, right? I'm not going to take trades unless it's obvious, screaming at me. I don't.
Of course, you're dealing with, as you point out, documents, but the markets looked like they were.
Where do we go? Right, it's tough. We've hit a big target coming into a slow hour. Curious. Let's get Michael Coe up here and lead into this conversation. Before we,
there we go. Sorry, I know that what they're doing is very technical, and they're in a room and they're bouncing ideas off of each other and stuff, but I prefer just being in my high income ETFs and doing a few options contracts and just not being in it all day. But people do listen. They go into this and they listen to it all day.
we do. Just a big reminder for the audience, we do talk a lot of tickers on these conversations. So just a quick disclaimer for you. An investor should carefully consider a fund's investment objective, risk, charges, and expenses before investing. A fund's prospectus and summary prospectus contain all this and other information about YieldMax there. You guys can find that prospectus on yieldmaxetfs.com and everything else that you want to get familiar with on there. But no, we have Michael Coe joining the stage. What's up, Michael Coe?
How are you, sir?
Doing well. It's been some crazy days in the market, obviously, with things breaking out over the weekend and a lot of volatility, which I know is going to be pretty awesome.
So much volatility. And on day when I literally can't see, it probably would have been better for it to be slightly down day yesterday, because that way at least my options wouldn't get out of control. But it was like 3 p.m. and I was like, I need to make sure that I'm not like I had to roll over some options yesterday because I was like, wow, this is getting really close to my like the strike price. I don't want to get them called away while I'm blind.
Awesome for some distributions, I imagine, but the volatility has been crazy. I actually just today took my first trade of the month. And I'm a day trader, right? And most people think we're taking a lot of trades most of the time. I literally have taken one trade this month, and it started today. It was a beautiful one. Took it all the way into these previous week highs that are.
I think I'm not a day trader, but a lot of people get impatient in this type of a choppy market. And then they wind up getting either too conservative or too aggressive. And then the market does something, and then they feel like they get wiped out. So, steady as you go, DCA.
Monday's highs, and last Friday's highs. So nice move for the market. But yeah, just crazy stuff. I haven't really been doing much, just trying to stay out and stay alive while I know a lot of people are probably getting killed. So, but how are you, Michael?
I'm well. Like everybody else, I'm watching the developments with significant interest. As we take a look at what happened over the weekend, and obviously that's had some fairly important implications for a lot of equities. We can kind of see that there were plenty of market participants who were for positioning for something like this, arguably, since that early January period, because oil, for example, was really flat to lower for the month of December. It didn't catch a bit immediately off of the remarks that the president had made on January 2nd. So for those who, were paying attention, there were some protests that have been attributed, I guess, to, among other things, a significant weakening in the currency over there in Iran. And as those protests took place, the president came out, made some comments, said that the regime shouldn't attack the protesters. And I think the markets looked like they were digesting that a little bit. And oil really started to catch a bid because
So a lot of people were saying Monday is going to be like Black Monday and the market's going to be super down. But I agree with Michael Coe here, where yes, this wasn't exactly the most subtle thing that ever has happened. And so it was getting priced into the market. So it could happen worse if this was out of the blue. But the market was able to kind of predict this in a way, or at least hedge against it ahead of time.
As almost everybody listening here will know, that it's an oil producing country, but that's not really the issue, because due to embargoes, the West doesn't consume a great deal of their oil. But they've threatened the Straits of Hormuz in the past, and 20% of global oil consumption flows via ships through that strait. And so we did start to see some significant positioning, and oil really caught a bid on the heels of that. I don't know how many people anticipated what happened over the weekend, or maybe suspected something like that might happen, but didn't know exactly when it might. Certainly it seemed like there was a risk that something could conflagrate a bit, considering we had two carrier groups in the region, which was kind of a big show of force. And then it happened, and now we're in it. So, the way they have traditionally sort of handled that is, they don't have a real navy, or didn't, to speak of, but they certainly had the capability to threaten merchant maritime in the region, and there's a lot of ships trapped in that area. So probably not that surprising to see the volatility that has accompanied that as people tried to digest what the implications for all of this were. And I learned some things over the course of the weekend as I watched these events unfold that I didn't know before. For example, I didn't realize that the insurers had the ability to clip the war risk insurance that they had with just 48 hours notice. Found that rather extraordinary, I have to say, because I thought, if I was in shipping and I purchased war risk insurance, ships don't move that fast, right? So if I was insured and suddenly I get a cancellation that says, your insurance is over 48 hours from now, it works, I guess, for whatever ships I might happen to have that are in the affected region, wherever on the globe that's taking place. But then effectively I have no insurance thereafter. It made me begin to wonder how much utility that insurance has. It's not.
Insurance is awful. Honestly, I have to call the specialist and have them do a letter of pre-authorization for the surgery, and set up the bill pay and everything. And I was really upset when I found out I needed surgery, because I don't want medical debt on top of all of the other debt that I won't have. But I have an HSA, so and it's through Fidelity, so I'm investing all of it into basically high income ETFs. So I'll get the bill, I'll pay the bill through the ETFs, and it won't affect my budget. But really, insurance is the worst, because I have to make sure that it's in network. It's not the best insurance plan. It's better than Medicaid, I think. So we'll just see how much insurance even covers if it's in network. And it could be a $5,000 surgery. It could be $50,000. It doesn't matter, because I have to be able to see. But yeah, insurance is the worst.
Not much good if your insurer says, yeah, we're going to insure your house against fire, but as long as it doesn't catch fire. So that was certainly very interesting, but going to be some interesting times for sure. And interesting, and your decision to get involved just today for the first trade of the month. Kind of nice that you're probably on the sidelines ahead of time.
Honestly,
But-
yeah, I'm very glad I've been on the sidelines. And, everybody has different systems out there. I'm not saying you couldn't have been trading a lot of this volatility. It's just personally for my system and the way I trade and have conviction in the market, I was sitting back and just not getting those obvious, clear entries, right? I'm not going to take trades unless it's obvious, screaming at me. I don't want to really be trying hard for it, right? Because to me, it's never brought me good trading. And so, yeah, being able to sit back, it's personally, I think I've saved myself a lot of money. I think a lot of the trades that I maybe would have taken, quote unquote, or would have tried to take, I would have lost decent money on and just been in a hole, right? Well, instead I'm able to save money, and then it might be boring, but you come in, you capitalize when it matters, like a day like today, and we're doing all right, So it's tough to do, but it's definitely needed in some of these times when volatility is just crazy like this. And I know as day traders, even swing traders, you feel like you have to be a part of the market, all the time, and you don't. It's a nice thing.
We are typically.
I like that sentiment of having the self-discipline of knowing when the market's just not right for you to play in it. I also just think that for the most part, we should just be sticking to the plan, just DCA into this stuff.
From a YieldMax perspective, we are engaged in the market each and every day because, of course, we're managing assets and we have exposure.
That's what we pay them for. It's okay to pay people to do things that take a lot of management and, not mechanically difficult, but this type of a market does take a lot of management if you want to maximize your yield, which is what YieldMax does. So
to a lot of underlying stocks and in some cases industry groups via sector or industry ETFs. But from our perspective, as one would probably expect, these are options income ETFs. When you start to see events like this take place, uncertainty rises. As uncertainty rises, so too do options premiums. And so, what that is going to mean for us is that we will be collecting greater options premiums as a function of the underlying stock prices. You're not going to see that for those who are looking. And to your point, I encourage people to go to YieldMaxETFs.com to learn more about us, to see the family of funds that we offer, to find the various prospectus on each of these funds, and also to get tax information, which you can also get at that site by going to YieldMaxETFs.com/tax-documents. But just sort of to...
I've been meaning to tell you all about that tax documents section, but I never remember what the actual URL is. I think it's YieldMax ETFs tax documents. There we go. Tax-documents. And they have the ICA. Okay, so they have the tax insert for 2025. And they have the percent in ordinary income. So it would be Apple is 70% return on capital because it's 30% ordinary income. So if they made a profit, then it's income, and if they were able to take the losses because of how their options work, then it's return on capital. So you want it to be like the NASDAQ 100 one, that you're not paying any money because it's basically 1% that you had to pay taxes on, which is great. So just putting that out there, that is the thing that they have. I also wanted to say they're going to mention it at some point, but hopefully I'm done with this and I'm able to walk my dogs and then go to this. But they have the 4 p.m. live stream today. So I don't know if they're going to have guests coming on or what he's even going to talk about. But We'll see. I'm not sure if I want to cover YieldMax twice in the same week. Maybe, but if it's really interesting, I'll talk about it. Or I'm just clicking on random things now, don't mind me. Maybe I'll just watch this. I'll participate in this on Wednesdays, and I'll listen to the thing on Michael Coe's live stream on Thursday, and then report back to you all on Friday. We'll see. We'll get a cadence in here. And it's only because that's at 4 p.m. and usually I try to publish my videos at 4:45 unless I don't upload it in time. So we could just upload later on Thursdays, but hey, we'll see.
Catch people up on some of the changes that we talked about a week ago. One of the things we talked about was going to be the rebalance that we're seeing in our YMAX fund of funds.
Yes, let's talk about that. I have questions. Hopefully other people we were on the same wavelength and they asked.
And I thought one of the things we could start off with today, just as a quick reminder, YMAX, the fund of funds, was an equal weighted exposure historically to YieldMax funds, other than other fund of funds and products like that. But that has been adjusted to try to allow those weights to float a little bit more, to have greater allocations to the areas where we have higher conviction being defined by those areas that are seeing some momentum. And the net result for anybody who hasn't looked, I figured we should probably just make a quick mention that there's been some pretty big changes. So I encourage people to check that. If anybody here is unfamiliar with ETFs generally or YieldMax ETFs specifically, most ETFs are what we call fully transparent. Fully transparent means that the holdings for the ETFs are published every day, overnight, so you can always see what the holdings are. And in YMAX's case, those changes have been pretty profound. So the number...
I thought they were going to do the changes on Friday, and I went on Friday to see their holdings. But I think they did change it on Friday, but they didn't publish it till Friday evening. So, but now they've made their announcement, and they made a good infographic, so that's what we got. But yes, it is a very profound change that they did to YMAX. It almost changes the entire purpose of why YMAX exists in the first place. But I'm not mad at it. I like having Renty in there and Soxy.
The number of holdings in YMAX has gone down quite a lot because we reduced, or actually eliminated, I should say, exposure to quite a few of the underlying ones, and we added just 5. So the net count, essentially, of the holdings there is much smaller. The ones we added were Chippy, which has been one of the better performing funds for those.
So far, semiconductors are cyclical, so, it could go on. It could be a super cycle, and it could be another year or two, or tomorrow it could go down 80%. Nobody knows ahead of time.
That are not familiar with Chippy, as its name implies, exposure to the chip sector, to the semiconductor sector. That's the YieldMax semiconductor ETF. We also have put Soxy in there as well, which is going to have exposure to a lot of the same types of names, but is actually one of the target 12 family of funds. So this is one that's going to make smaller distributions and try to have a little bit more focus on appreciation. We added RDTY, which is the Reddit options income ETF, Renty, which is real estate, and Alti, which is the portfolio where we typically have higher distributions and higher volatility names, although there is sort of a...
Did they say Reddit? Hold on. Did I tell you all wrong before? Oh, was Reddit just... Is that what the RDDY... Oh my gosh, y'all. Maybe I need to pay more attention to YieldMax. No, that's the Russell 2000. Okay. Isn't RBLY, isn't that Roblox? Hold on, I'm so sorry, y'all. But this is gonna be RBLY? Yeah, that's Roblox. There's no Reddit. Reddit was... Is it the Ready one? I thought it was RDDY. I think what happened was that, is I always think it's RDDY, but it's RDYY. Is the Robin... Sorry, Reddit. Yes, okay. RDYY got kicked off the island. Yeah. Okay. Now back to our regularly scheduled program.
Core set of underlying stocks that are in there, and also a non-correlated sleeve and a special sit sleeve. So some of those stocks have, because we were just coming on the tail end now of the quarterly earnings season, some of those stocks have moved a decent bit, it should be said. If we're looking at Ulti, for example, MongoDB didn't have such a great result, but it was okay in our case because that fund typically has collars on the positions. So if you're looking at the stock now, you're going to see that thing's has fallen pretty precipitously. It was, I think, close to 315 when we last spoke. Trading about 250, a little less right now, so that's a pretty sharp drop. But we owned the 292.5 put.
I know we love to hate on YieldMax at the moment, but they really are being more careful with the collars and everything. And Ulti's supposed to be into higher implied volatility, which means that the prices move more. And if I did this on my own, I would probably be losing a lot more money than what Ulti is losing, like per trade. So there's that.
The trading team was able to roll that position within the first, I think, 30, 45 minutes trading yesterday. So able to harvest some of that hedge, and then adjusted the position commensurately. I think they rolled down to the 250s or 255s. One other thing I should probably mention, because we tend to talk about the markets, we tend to talk about the funds, the holdings they're in when we do these spaces with you guys, but sometimes it's necessary to be able to show, not just tell, and dig into some of these things in a little bit more detail. So we've decided we're going to do that with basically 30. We'll see how long it's going to have to go, but it's going to be 30 minutes, and maybe it might even increase to an hour, where we basically take people's questions. People can submit their questions to YieldMax ETF's X handle, and then we'll assemble a little bit of collateral, and then post-close on Thursdays, we'll put some of that collateral together and discuss it with anybody who's interested. So I strongly encourage anybody who has sort of more in-depth questions that we might be able to answer with a couple of slides or a little bit more of a visual drill down, to follow the YieldMax ETF's X handle, and we'll be doing that live on X after the close tomorrow. So quite unlike what we're doing here and the things that you do, which is very valuable, because of course you're dealing with, as you point out, you're a day trader. Many of the people who are following you probably are trying to figure out how to navigate the market in real time. What we're going to be doing is sort of a slower paced, sort of more of a 15 to 30,000 foot view.
Sometimes these things really are easier as concepts when there are visualizations. I really hope that they ask when is the next rebalancing for YMAX, because YMAX is supposed to rebalance once a quarter. This is mid-quarter, so the first one, I guess, is not on the schedule
Of what's going on with some visuals. So I encourage people who follow that handle to tune in after the close tomorrow.
Yeah, that's going to be awesome. I saw you guys were doing that. So make sure, if you're in the audience, go to the YieldMag ETFs profile here, and you can find all the information for the live stream tomorrow. It's going to be awesome. I'm psyched you guys are doing that. And like you say, give a little bit more visual for the people there. I want to talk a little bit about mining, because I know we mentioned that was launching last week. It looks like it started trading like officially on Friday. And yeah, just curious on your thoughts there. Like I know you guys are coming out kind of trying to capitalize on the miners there, and obviously a lot has been happening in the Middle East with oil and maybe gold and silver moving around as well. So I'm just curious on your overall thoughts there and how that's affecting things in this area.
Yeah, well, I'm excited about the fund, of course.
I'm a little perplexed because I thought these were the safe haven funds, but then people were like, and it worked well on Monday, but then the rest of the week people were like, oh, we overreacted, so now we can get out of gold, I guess, but the market's still going down, and now my portfolio is going down because I have a lot of gold and silver, so there's that.
Of course, I think it's a great way to get exposure not just to the precious metals, but the industrial metals as well, rare earths, stuff like that. Timing could have been a little nicer for us, right? Nothing like going out and buying some stocks on a Thursday and Friday and going to war on Saturday.
That's how it goes sometimes.
Yeah,
right?
that's just
Amazing timing. This is why we don't time the market.
I was taking a look at the week on week performance of the constituent stocks that we hold in there, and a lot of these are the kinds of names that you probably would expect to see. We've got some Freeport in there. We've got Rand Gold. We've got SMR, which is New Scale for those that don't know. Southern Copper and Caterpillar and BHP and Albemarle, Hecla Mining, Pan American Silver. And, the week-on-week performance for a lot of these stocks, net of what happened over the weekend, hasn't been too great. That's going to happen. You're going to have industry exposure, and some are going to do better than others. And, I kind of wished Anduril was a publicly traded company, and we might have owned a little of that going into it, because one would assume that a company like that, had it been publicly traded, would be substantially higher on the week. The names that I just listed, there's only, we've got one that's flat week over week. We have two that are higher, and the balance of those are all lower. So that's going to happen with the global events that I've seen. I'm sure a lot of the people listening are trading, but experiencing the same thing. But yeah, we're pretty excited about that. And on top of that, these are the kinds of areas that are also going to probably get even more of a bid to options premium and.
Yeah, so I finally put TLTW back in my portfolio, even though I don't particularly like TLTW, just as like a general hedge. And then because, we started a war, that is now holding, that is down. So I don't even like TLTW to begin with. And now in this very specific situation, it's not hedging the way that I want it to. But it's staying in this time. And I'm just going to have to deal with my feelings.
Volatility when things like this go on, because these are the companies that operate all over the world. You think about both, the supply and demand imbalances that can emerge, sort of the greater the geopolitical risk becomes. options premiums are going to rise more and stuff like that than they will in a Kenvue or Procter and Gamble or any kind of a staples stock.
False. HCal was also down more than the S&P 500. I think because they do rely on shipping and everything like that, people are more concerned about how this is going to affect those type of companies. So there's that.
Okay. Many of those, obviously, staples, utilities, and sort of those safe havens and dividend names had been seeing a lot of money flows over the course of the last days and weeks on what's going on here. But yeah, we're definitely looking forward to this fund for attracting some assets and hopefully giving people exposure to options income and in this space.
Yeah, big shout out to that. CryptoFit, got you on stage. You got any thoughts on mining or what's been going on this past week? I know with everything happening, hitting over the weekend, probably shaking up some portfolios and making some crazy stuff happen. So I'm just curious what you're looking at and what your audience is interested in here.
Yeah, I mean, congratulations on YMAX. I think I counted. I think you guys moved out 25 names.
CryptoFit is always very, very complimentary to YieldMax and their team, but he also makes really good points. So, and he really tracks on, I think, Ulti. So I think he's complimenting them on their trades.
Michael, close to that?
Yeah, I think, was it 25 or 24? Let's see.
Somewhere in there.
10, 12. Yeah, I think it was, we shifted out 28, I think, and moved 5 in, net 23.
Yeah.
If I'm doing my math right. Yeah. So, it's a much more concentrated basket at this point with 16 underliers in the portfolio post reval. And I kind of touched on this last week, and I've made the point in the past that there are environments where equal weight portfolios can make sense, and they have their place. But I think that operationally, these shifts that the team made a lot of sense, and I also like the fact that it's likely to allow winners to run a bit and to contribute a little bit more to the portfolio performance. Also, I think that it's easier sometimes when you're looking at a portfolio of stocks. You look at a fund that's got 50 names in it. Let's say, I'll just as a hypothetical, and they're all equal weight. How much do you really care about any one of those underlying securities and how you feel about it? I think with the new structure, it's very easy. You can take a look at the constituents, you can look at their weights, and you can say, this is what I'm betting on.
To be fair, things like Biggie that do have 50 and I don't care, like, you don't have to know what's in it because it's the 50 biggest companies. I think the problem with YMAX is that it was the single stock tickers, and when you have to have the single stocks, it has to have the volume, it has to have the volatility, the popularity, like it has to have all the correct ingredients for it to be able to be offered as a single stock. And so and those tend to be higher risk things. And so like I also would like to not care about the individual constituents for YMAX and for it to be 50, or just like as an example, I don't mind having more tickers, maybe with I do like it being cap weighted or whatever momentum weighting. And, because sometimes you're not expecting it to go up, but then it does go up. So, and the reason why we do like the S&P 500, only the top like 100 or 50 of them are on any given day actually contributing to the S&P 500 appreciating in value. But in times like now specifically, having those other companies that are in different life cycles and in different industries really help the entire index from bottoming out. So I understand where Michael Coe is coming from this, where by having less, we can look through them more and understand what we're investing in easier. But at the same time, I would still like to not care and for it to just appreciate in value.
And I think from an investor's point of view, that's really helpful. If you imagine what's taking that all the way to its extreme, you could look at something like InVet, which is the target 25 on NVIDIA, or NVIDIA, which is the options income ETF on NVIDIA. And you know what you're getting, right? You're getting long exposure to NVIDIA. You're getting options income on top of that. In one case, looking for a little bit more potentially capital appreciation than the other one, just taking out whatever distributions you can. But I think that as an investor in ETFs generally, if you bought something that owns a tiny bit of everything, it's sometimes hard to understand, what am I allocating to and why am I doing that? And so, personally, I'm very much in favor of the shifts that are made, and I encourage people to take a look at what's in the constituent.
Are you kidding me? The amount of people that, I think it's VT, they're like, just do the entire stock market. You're going to be fine. You won't do worse than the entire literal world. That's easy enough to remember.
List in their respective weights.
Yeah, and you know what you did really well is you didn't fall victim to just listening to the complainers who are just blindly saying, hey, I want a 50% yield and I want 30% price growth without having to reinvest a single dollar, which is amazing, because what people don't understand, and this will come to a question in a second, but if you're listening and you love Alti so much, right, which I own Alti, I love Alti, and you don't understand what you're investing in, you have to, maybe if you want to have a balanced portfolio and still want income, maybe you do have to look into something and balancing it with a biggie or a salty or whatever you want to do. I'm not an inverse guy. I don't like betting against the market ever, although there are times where it is definitely the right move to do. Case in point, MicroStrategy. But honestly, what I'm hearing in my group, and I love learning from you, Michael, each week, is it's
I mean, to be fair, I would love to get the 20% price appreciation and a 50% yield and not have to reinvest all of it. And I'm being a little sarcastic, but also let a girl dream, okay? Let a girl dream.
Just so much Bitcoin Treasury, STRC, SATA talk. And I'm in it too, right? People are like, why would I ever want to invest my money in something that is so stable? It's never going to depeg much from $100. And I get where they're coming from. I get that, 11.5 to 13.5% seems crazy, right? Like if a product like this exists and nothing ever happens, then finance as we know it will have to change, right? Because it just doesn't, yeah. So my question is, I had a debate with somebody about like a Big E, a QQQI, a SPYI, all the typical ones that are following the index, why it is much safer, not financial advice, but safer to have a position in that than versus just having a 100% allocation to, an STR.
Oh, I can answer this. I was actually in a conversation with the income architect, Brad, and he mentioned CAP-M, and what that does, it calculates your, oh, okay, well, now I'm gonna have to explain it, but like, it's a formula that basically, oh my gosh, okay, I don't want to say it wrong, but so there's different things that you can do for formulas to think about how much are you actually expecting this ETF to grow. So basically for CAP-M, you are asset pricing models. So this is how much you're expecting it to grow. And as long as the amount of options that you yield from it is less than what you're expecting it to grow, then it's safer. So if you can figure out how to do this model, and then you have a percentage, not just like, I feel like the NASDAQ's going to go up 20% next year type thing, like I use actual math, you can then calculate, okay, well, if they're yielding, the amount that they're yielding above this is what I need to reinvest in order to not lose money in the fund. But if the fund, like if the S&P 500, we're expecting it to go up 13%, and that's yielding 11%, then you don't necessarily need to reinvest because it should be able to appreciate over time. But we'll see what they say.
STRC. And I just wanted you to know, you don't have to diss any product or any industry because it's not one, MicroStrategy or Strive or anything. But what could go wrong, hypothetically, with this play?
Please don't challenge the power worse. There's a lot of things that go. Mostly, I think it's like MicroStrategy just files for bankruptcy and doesn't exist anymore. If it doesn't exist, then nobody gets their money anymore.
With which play? Buying
With any ETF that is, a Bitcoin treasury company that essentially is issuing a bond against what, the Bitcoin that they hold, and they're betting on the price going. I mean, obviously the easy answer is, hey, the price goes way down, and they have to end up selling. But apparently they still should have enough to buy back your stock, your ETF at $100. I think where people aren't understanding is like, well, they can also go bankrupt and not do that. But I want to hear from your professional opinion. And I think a lot of people listening to this, because it's running wild. The STRC, SATA community, it's running wild. So I would like to just hear your educated, not advice, right? But just what could in theory go wrong? There we go.
Yeah. Well, there's always something that can go wrong. And, those who have heard me
Always.
speak before know that, it's not, although I may have different opinions about other folks' products, to your point, I don't like to diss them because I think there's a lot of thoughtful people out there with interesting ideas that package those ideas into an investment product. And they each have their utility. I mean, one way to think about that, of course, is that if they thought of it, number one, that means they've probably done a little bit of market research, and then that market research has suggested that that's the kind of exposure that people are looking for with the benefits of an ETF wrapper. The benefits of an ETF wrapper being that they tend to be more tax efficient, they tend to be transparent, they trade like a stock. So all of that part is great.
I wasn't expecting to be talking about STRC and SATA today, as opposed to, the YMAX changes, but here we are.
Regardless. On the other hand, it is not necessarily, it doesn't mean that some dislocation can't happen between the pricing of the underlying assets and the security itself. So that's one area. Obviously, you're exposed to the risk associated with the underlying exposure that you have. And in some cases, that can be highly concentrated. Look, I mean, we've seen that ourselves. We have an options income ETF on Moderna. Moderna went through a horrific period. And the options income ETF was able to outperform it because it was collecting some premium. But that didn't mean that it performed well. You can't have exposure to an underlying asset.
It's kind of refreshing for them to be like, Moderna was horrific. We can say that now because Moderna is doing better, right?
That declines by 90% and expect that, options income is going to mitigate all of that, or even most of it, right? So that's your underpinning asset. So, that's, I think, the thing that people need to recognize. And I would say that
And should we be running back into Moderna or into Moderna in the first place? Probably not. And you should have a really clear think about, does this fit my investing thesis? And does it propel me besides just it having a good yield? Does it get me to where I need to go? Do I actually believe Moderna is going to go up and to the right in the future? And it's healthcare. And it's also, I think it's fintech. So I think Moderna was really the mRNA technology, whatever. Is it cyclical? I don't know. So I'm not investing in Mertny, but if Mertny's in YMAX because it's doing well, then, bully for it.
Industry, we've done a very good job innovating and creating products that can give people very tailored exposure in a handy wrapper. I'm not sure that the industry has done as good a job explaining that when you use the moniker ETF, exchange traded fund, what I think a lot of people hear when they hear fund is they think that there is somehow some kind of natural diversification. And these are really exchange traded products that are designed to be packaged into a portfolio, but they still wear that label. And I think that's one of the places where folks can find themselves getting a little something.
Yeah, because at the beginning, ETFs were mostly S&P 500 actual diversification, so they became kind of synonymous with being diversified. But obviously, single stock ETFs are not diversified. So, and neither is SATA or any of these that are bonds, but bonds with just one company. So there's that.
Sideways. Because then you can take a look at the performance of what they're thinking of as a fund. But really what it is a packaged strategy on an underlying asset. And that I think is one of the things and that's just a general comment about the industry. It's something that, we try to communicate. Not sure that we remind everybody as often as we should that, that's the way this is intended. If you're going to go and say, okay, well, I want to have a strategy, variable rate, perpetual stretch preferred share, ETF, that is not a diversified investment. That is a strategic, tactical bet that's been packaged into something that trades like a stock, and it should probably be just one constituent in a portfolio of strategies. So I guess that's about the best way I can say it without sort of lampooning anybody's independent strategy and speaking to it. I'll let the people that manage those strategies really dig into it if they care to, and I encourage people to go and check out all of their respective prospectuses to do that.
Would you say then is it fair for me to say to people, because I'm even getting these giant accounts and YouTubers, it's like they expect that since I'm just mouthy that I know a ton. I like to learn, but they will. It's safe to say if you are all in on STRC, then you are also all in on MicroStrategy. Like that, is that a safe statement?
Yeah. Well,
I'm not like all in on STRC. I have I think a share. We could look. It's not going to hurt us any. We've already been here for an hour. So Sailor Mooning at the moment, I'm pretty sure I'm 70 something percent in winter. 79% winter. And you know what? We're not going to sell this winter because right now in my margin portfolio, because I got my trailing stop loss got triggered yesterday. So in the worst case scenario, and Bitcoin goes down and I get a margin call, I can just actually transfer the winter asset into my margin account. And that, it's not that much money. It's $500, but that's $500 more than I had in that account if everything goes to shit. So yeah, I have half an STRC. I'm not going to, especially not $104. We're not doing that. But yeah, this, I would have to think about how to communicate to others if they should be excited about this or not. But I think this is something it's leveraged because strategy is leveraged. And I don't think it's necessarily ethical to be like, yeah, you should be in this leveraged product. You should be doing your own research and getting into the leveraged product because you believe in strategy and you believe in MicroStrategy. So that's kind of a tangent on top of this tangent, which we talked, I think, more than half of this time about STRC now. But be careful when anyone or any community is hyping anything. I didn't know that people were hyping STRC that much. That makes me want to like not be in it anymore, honestly. Like, but like, I believe in it enough to have half of a share in it. The reason why I haven't gone more heavily into it is because it only pays, that 10%. So, I've been doing, a little bit into Misty, a little bit into STRC, just for some like stabilization. But I think Michael Coe's correct here and to say it should probably not be like a large portion of your portfolio. But if you believe in strategy and you're in strategy and you want that 10% more income that's more stable, then don't pay over $100 for it, but, keep it in mind. Don't pay over $100 for it, okay? That's all I gotta say, I guess.
You know what this would actually be a good one for a visual. So let's see here. What I'm gonna try to do here is I'm gonna see if I can pull up I'm trying to do this on my Bloomberg terminal in the background. And then of course I can't show it with you guys. I was going to try to see exactly I was going to do a regression and analysis to show exactly what the respective correlation was. And, oftentimes you can just divine the formula.
See, I need to figure out what exactly Michael Coe can do in the Bloomberg terminal, because I just found out that it's like a $20,000 a year license. So if he's going to every Thursday do me a favor and do me visualizations through the Bloomberg terminal, we're just going to have to abuse that, because I'm not paying $20,000 for anything. I mean, eventually I'll be paying off all my loans, which do equal more than 20,000. You know what I mean.
Essentially the way that you can think about it. You could actually do that with Misty too. But yeah, that's really the gist of it, right? You are taking exposure just elsewhere in the cap structure, I guess. So just to give people a little bit of background here, because we do have exposure to MicroStrategy via Misty and via some other funds. So I can certainly speak a little bit to.
So yeah, the changes from YMAX actually puts us into a position where once they rebalance and you know what the holdings are, then you can go and do your own research and say, okay, well, you don't have Misty in YMAX anymore, but I still believe in Misty, so I'm going to, on my own, outside of YMAX, invest in that to over leverage myself into that, because I think YieldMax made a mistake. So this kind of just creates more work if you care about the individual constituents that may or may not be in YMAX. But for me, like, not, and I know you're all gonna be like, that doesn't sound like you, Amy, but like, not everything has to have strategy in it, okay? It doesn't.
What STRC is. So STRC, for those that don't know, Strategy's balance sheet has gotten increasingly, their cap structure, I should say, has gotten increasingly complex through time, right? So, you think, most people think of Strategy, the company, and what do they think of? They think of MSTR.
Data centers. Just kidding.
The stock. But of course, they've gotten very creative with the way they raise capital to get exposure to Bitcoin. And so now you have the stock, You have
Mr. buying Bitcoin because I'm too poor to do it myself.
6 bonds and a handful of preferreds. You're referencing one of them. So the thing about these is that if you're looking at a preferred, what is preferred? Preferred is kind of like a hybrid between a fixed income.
I think the original question was, my audience is now getting hyped about these weird products, niche products, trying to get some alpha. And I think the real answer here is just like, hey, I know that we are all like anxious about this sideways market, and we're all trying to find a way for more for this income that we do have. We need it to be more stable, and I'm experiencing this as I go along. Like, as I have more money invested, as I'm experiencing, hey, I've made enough money to make this more sustainable, even though I am getting around a 50% yield, I'm seeking ways for my portfolio just not to move as much, because like a little bit about being retired or, forced into retirement or whatever I am right now. It's just like, I don't need to grow. I do need what I have to be stable and sustainable. So I think the real answer is just to advocate like, hey, diversification. The majority should probably be in the S&P 500. And then if you're feeling risk on, maybe have a bit in the NASDAQ 100. And if you have some extra money, the Russell 2000. And, BNDI, even though we don't really like bonds too much. And TLTW, even though it's in the US dollar, I think, trying to say, instead of like STRC as like 0.5% of your portfolio, like it won't hurt anything, but there's no reason to get so hyped about it, because it shouldn't be that large of your portfolio. We should just stick to the plan of being more diversified into things that have less yield, that are less exciting to talk about, because that's how you're going to win in the long term, is just not getting over concentrated in these hyped things.
Security, like a bond, and the equity resides between them. It's senior to the equity in one respect, which is that in the event that Bitcoin, for example, really goes even much, much lower, eventually the equity is the most subordinate layer. You're at the bottom of the waterfall there. And preferred, being senior to it, has a higher claim on the underpinning assets of strategy. And strategy's assets are Bitcoin. That's really the only asset it has. And actually, there's kind of a corollary here to some of the things we've been seeing elsewhere, because actually, I think it's kind of interesting what's going on in software and services. So if you take a look at IGV, which grossly underperformed all of tech in the second half of last year, and underperformed, if you can believe it, even worse since the beginning of this year through just over a week ago. And it caught a little bit of a bid beginning, it was last Monday, last Tuesday. The thing about software and services is that, unlike sort of old economy businesses, these are very asset-light businesses. And what that means is that when you look at...
They were asset-light businesses. That's why there's been a lot of pushback with, Amazon and Meta and all of these, the Mag 7, because now they're building their own data centers, which are assets, which means there's going to be depreciation in the future. And now they're not this lightweight, like they can change their entire business model in 30 days because all it is software. Now they have entire like physical locations that, there's a question about how often and how expensive is it to like remain relevant in the thing. So yes, traditionally they have the traditional businesses and then they have the software businesses, but traditionally the software businesses are light on assets. And so, they're higher growth because their, profits are really large because of economies of scale.
their cap structure and you think, okay, well, what if everything here goes wrong? What do claimants have to get, basically, right? So why do banks not really love to loan to software businesses? Because they don't have buildings, they don't have equipment, they don't have inventory, they don't have essentially collateral that they could say, well, I have some recovery here. Well, in the case of Strategy, before they became a Bitcoin treasury entity, they were, software and services businesses. So there isn't really any recovery.
So banking hates software companies because there's no collateral. Okay, that makes sense.
There, and that business wasn't that large to begin with. Certainly, it was not anywhere near on the order of magnitude of the size of the company now in terms of its market capitalization and enterprise value. So the thing that the folks who have the preferreds get is you do get some exposure to the equity. Not all of it, but you also have some of the benefit of being a little senior in the cap table. But at a high level, you're right. The way you should think about that is, I actually think about it more in terms of I'm essentially finding another way to buy Bitcoin. That's the way I think about the preferreds. It's kind of a way to get Bitcoin and clip a coupon out of it and have some convertible feature. I think they are thinking, the interesting thing, whether you like Michael Saylor or not, or you like Strategy or not, is that in their own way, they're trying to think about, what they offer investors. In their case, they're trying to raise capital to buy more Bitcoin, but they're trying to think about different investors and different sets of investor needs and give them exposure to the same underlying asset. That's why I thought their first effort on the zero coupon converts was really a good one, because there's a big class of investors out there that probably wanted to have exposure to crypto, more specifically Bitcoin. It acts as a bit of an inflation hedge, but let's say you're a fixed income manager. This is something I brought up before. And you can't buy that. That's outside your mandate. That's not a permissible asset. You couldn't either buy crypto itself. You can't buy a stock that holds it. So they couldn't buy Strategy stock. Can't buy Bitcoin, but they want exposure. So sell a convertible bond. And now you have that exposure. And in 2024, it was really remarkable. I did a calculation and I figured out that, if you had just allocated 1% of a fixed income portfolio to the zero coupon converts on December 31st, I think it was 2023, or thereabouts, and held it through the end of the year, that would have tacked 150 basis points onto your performance, which is a huge amount of money for a fixed income manager, right? So I think the purpose for all of these things is, a lot of different securities and a lot of different types of investments have utility for, different types of investors. Now, for most of the folks who day trade, are self-directed, would that be the first place that I'd think about getting exposure? If I don't know how to look at a cap table, if I'm not really valuing the whole business relative to their Bitcoin holdings, and I'm only being enticed by the fact that it looks like I get exposure, but I also get this preferred dividend, I would say that you're making an investment decision based on only half the picture. You're getting exposure to the same things that this company is doing. You are senior to equity, which is good. You're subordinate to those 5 bonds I just mentioned. So just bear that in mind. So those are the kinds of things, is that when you start getting into those sort of hybrid securities, people need to understand that stuff a little bit better. But at a high level, yeah, you're getting exposure to MicroStrategy and what they're doing. There is one other thing which I would remind folks.
And the reason why YouTubers are going to start talking about STRC is that people are getting excited about STRC, and we like it when people click on our videos. So it's a little bit on all of us for clicking into things and getting the things hyped, but just putting that out there, that it kind of feeds into itself that we want people to click on our stuff. People are interested in STRC, so we're going to talk about STRC. And then people hear about it all the time. It gets normalized, and then they invest in it, and they don't quite understand what they're doing. Also, I'm not saying that, we didn't do our research, but, sometimes we just don't know what to research when things are new, and so we may have missed something important in our estimation of what our risk tolerance is for this type of investing. So I can't believe they spent so much time talking about STRC today. Now I'm going to have to put STRC in my title so that people will actually click on this. Hopefully I don't get copyright struck from this. They don't strike me as the type of people that would do this, but this is the Wolf Trading X account that they do this every Wednesday at noon Eastern time.
Which is that, preferred dividends, unlike bond coupons, and they have a lot of zeros and a lot of the bonds that they have.
Hey, this is an actual dividend, which means if I hold STRC for a year, that should be long-term capital gains, right? Right?
That pay coupons, they're very modest rates in any case. They have said they would not, but you can always suspend a preferred dividend. That doesn't trigger anything. What I mean by that is that if I have a company ABC issues a bond, and that bond's supposed to be paying coupons, and I fail to do so, I'm now effectively in breach. And so the holders of those bonds can force my hand. Ultimately, if there's only one bond and they're senior, they get what's there. They get the underpinning assets. Preferred stock doesn't have that. Now, they've indicated they wouldn't suspend, but I'm just going to offer that it's not quite the same kind of guarantee that a bond coupon is, to the extent that a bond coupon is a guarantee. I mean, you're still, of course, subject to credit risk.
Well said.
Jens, did you want to come in with any thoughts?
Yeah, I have a question about. I love the new YMAX, the change in YMAX. I have a question about it. Are you just
Finally, someone has a question about YMAX.
focusing on the momentum plays? Because I noticed you added Ulti and Chippy, which I love, and Soxy, which I love. But you added Renty and not Biggie, which, I'm more a Biggie fan than a Renty fan. And then you left Murney, which I assume, Murney's been hot. And the Exxon fund, is getting hot. So is it just based on momentum? And I assume the rebalance is monthly. Is that too long in case, things change quick? Can you go in and swap something out or what? That's my question.
Yeah. So the metrics that the investment team is using for momentum measurements is has a 21-day calc period. So it's not going to be immediate. One way to think about it is that if you're a day trader and you're using technical indicators and there's people on this call that are better suited actually to even talk about how they think about these things than I, because
Don't worry, Michael. You can roast me. It's okay.
no, there's no roasting going on. I mean, I have not been a day trader in my life, largely because, when you come from the institutional side, has been no way in institutional trading experience where nobody goes home flat. Right? You get into things. It takes days sometimes to get into them. Sometimes it takes days to get out. Sometimes they were roach motels and I couldn't get out. I can think of Philip Morris leaps back in the day, and having the specialist just yell profanities at me whenever I was trying to unwind some of the exposure I had there. So it's just a story probably for another day. Might interest a few folks. But if you are taking those, if your time horizon is going to be as short as that, you are likely going to respond to things that happen intraday and, and without hesitation, right? So YMAX that's not the kind of momentum we're talking about. This is not a situation where YMAX is looking at, candles or very short-term moving averages or anything else. And the traders are saying, it's time to move. This is really about getting exposure to the funds we want to have that are moving in a positive direction. The ones that are doing better are going to have higher weights, but also some of that happens automatically, right? So if you allocate to 20, let's just say we started with an equal weight portfolio, and you allocated to 20, and actually it's 16, I think in this case, 16 underlying funds or stocks, and you're allowing momentum to do its work, you're actually going to naturally end up with greater allocations to the things that do well. So this is not, it's not a short-term trading strategy that's going on underneath the hood. And part of the reason is that, we're hoping that products like YMAX become, popular as an investment strategy all their own. Now, I also am a big fan of Biggie. And the reason I like Biggie is because Biggie is sort of the truest test of how you harvest options income out of equity exposure. And the reason I say that is because Biggie, its underpinning stocks, essentially being the top 50 largest constituents, is going to behave a lot like the S&P itself, which is probably the best proxy for U.S. publicly traded stocks. So really, when you're looking at Biggie, you're saying, I want long equity, not just like, but very, very similar to the S&P 500, but I'm looking to collect, give or take, about 1% every month. So very straightforward, deploy that options income overlay approach, and I'm not having any influence whatsoever on the underpinning security selection. YMAX having more of a momentum focus, how do you incorporate momentum just for equities generally, right? You can have exposure to it, whereas YMAX is getting exposure to subsets of equities that are demonstrating, momentum. And, look, there's going to be shifts in this. It's going to respond dynamically, but it's not it's not going to happen with the kind of alacrity that many of you guys listening act with on your own behalf, trading as you do intraday.
All right. Thanks, Mike. That's it.
I don't think they answered the question. In the prospectus, they rebalance once a quarter. I think they might be able to add things intraday if for some reason, they had Misty in the portfolio and it just went down 10%. I think they could add winter in ad hoc, but I think I asked that last week, but I guess we'll see how it is. But he just said, hey, we're going to look at a longer time horizon than just at this exact moment. And that's why it makes sense for them to have the Russell 2000 and semiconductors and maybe not the 50 largest companies, which I think they could have added just to, have a little bit more stability. But hey.
Some great thoughts, crew. I wanted to ask Michael about just with everything going on in the markets, and I feel like the main idea that investors are feeling is you've heard people say investors are feeling a little impatient about the AI trade right now, and maybe there's some rotation happening, into some small caps and maybe some oil and gold and some other areas. I'm curious, when you're experiencing a market like this and kind of rotation out of some of these AI leaders, the strategies like QDTY, the zero DTE call option strategy, does that kind of perform well on those shorter duration kind of option tactics? I'm curious how you guys worked those in.
Yeah, so that's a very good and thoughtful question, because let's think a little bit about, and this is something options traders think about all the time, which is, the interplay between volatility that you see underneath the surface. So when you look at something like QDTY, or anybody's product that looks to trade options on a broader index, whether it's the Nasdaq 100 or the S&P or the Russell 1000 or whatever, that index, the volatility of that index may not reflect just how turbulent things are underneath the surface. And the way options traders think about that relationship is correlation. So in a highly correlated market, it's going to be very risk on, very risk off. It's going to be indiscriminate, which is to say people get panicky. Think Liberation Day. Everything gets sold. That's a high correlation environment. And that can be difficult if you're selling premium on an index, because the index options will typically be priced assuming that things are not perfectly correlated. There's, if you took the weighted volatilities of all of the constituents of a portfolio and you added it up and then compare it to the options premium for the index, of which they're all constituents, you're going to see that the options premiums for all of those constituent stocks is going to be higher. And it should be, because most of the time stocks don't track perfectly with one another. And so the sort of the surface of the water, if we think about it like that, which is the index, is going to appear calm, but stocks underneath the surface, kind of like the fish down there, are all going in different directions, right? Now, a benefit that something like QDTY and other strategies that sell short-dated options is that when things go wrong, that is to say correlation shoots up, at least you didn't do that out weeks or potentially months. And if you suddenly rolled into something like a GFC or some other systemic problem that plays out over a long time, that the options are going to reprice pretty quickly. So you might wake up on Monday and say, there's a war breaking out in the Middle East and the market gets sold off hard. Suddenly everything's, S&P's down 2%, NASDAQ 100's down 3% or whatever. And that's going to sting. But with the short dated options, at the very least, the vol surface should begin to accommodate what's going on pretty quickly. And now you're going to see slightly higher options premium, so you can probably harvest a little bit more out of it, and that's a good thing. Now let's also think about the relationship of that rotation that you were talking about, though, without thinking about options premium, and just as a market participant. We're all market participants. What do we think of this? I will say that that's a healthy thing, right? So I like to see a market where, maybe it's not going higher in gaps, and that's certainly the case for the S&P so far this year. We're basically in and around flat, but where you see that rotation, because it suggests that investors are being discriminating, and they are saying, hey, we've had some winners in our AI exposure. We've had some big winners in our tech hardware exposure. So now I'm only going back a week because, like I said before, the relative performance of software and services to hardware from the beginning of the second half of 2025 through last Monday, not this Monday, but last Monday, was more than 40% divergence. And that's after, in the preceding 180 trading days, they had moved lockstep with one another. IGV and XLK had traded within 10 bips of each other from December 30th of 24 to June 30th of 25. And so when you start seeing some rotation, I think that creates huge opportunity. And it also suggests that it's not completely risk on, risk off. Risk on, risk off markets are very, very difficult to navigate because you're just totally getting knocked around by the news cycle. You're like a ping pong ball on a pool table, just getting killed every single time something bumps into you. So I think it's healthy, and there were a lot of areas that have been left behind for a couple of years now, and some of them are catching a bid. We're seeing that in healthcare. We are seeing that in some industrial stuff. Certainly, we're seeing it in energy now. Energy is a little bit of a different animal, of course, because there's a good news cycle reason for that to catch a bid, but it was already beginning to come to life even before all this. So, as an investor, I think it's a good thing for us to see that. And as you look at the short-dated options income ETFs, understand that when you get something like we did over the weekend and you come in on Monday and the NASDAQ's getting clipped pretty hard, that's going to be a tough day, but it might actually create a better environment in the days and weeks ahead coming out of it. So it can be it's a way to think about things tactically. If you're looking at these funds, some of you might be investing in something like Biggie and saying that's an investment strategy. Right? You can allocate to that, and you can kind of use it as your home base. It's kind of how I think about it. Some of these other things are going to be more tactical, but I would much rather have the environment we're in right now than the environment I saw in late 2017, for example. Late 2017, for those that haven't looked at it, haven't looked back at that data, I encourage you to go see what the volatility in the S&P was in the back half of the fourth quarter in 2017.
Honestly, I didn't really pay attention. I was in the S&P 500, but it was mostly just my one taxable brokerage account and my IRA, which were both in Vanguard and both just 100% S&P 500. And since I didn't invest on a regular cadence, I would invest when I had more than the $10,000 in my checking account. I'd be like, why do I have so much money here? Just invest it. So I would just go in and be like, oh, I have more money, and then click and buy more S&P 500. So it is less stressful the less that you check it, but now I'm checking my account multiple times a day, so it is what it is.
Which came right before something most options traders refer to now as Volmageddon, when an ETP blew up in early 20.
I don't need any get-ins. No get-ins. I need a slow and steady get-in, okay? Like, we need to get in this market going up because, the sequence of return to risk with my portfolio right now is, I'm making enough money, but if we have a really bad day and I lose all my money, then, I've lost my money and I lose this, not having a job and it working out for me, or doing my entrepreneurship and getting, building my business and having the runway in order to do that without, completely stressing out and all my health stuff and everything. So, we don't need any get-ins. No get-ins. Please stop thinking about get-ins. I think I'm the only one talking about a get-in, but no get-ins.
18.
What if we kind of flip it on its head and I know we've definitely had plenty of spaces when we're in this environment, but just for the sake of the conversation right now, we're in high volatility, right? When the market's kind of drifting at those all-time highs, and you know how it can get when you just are in that kind of slow melt up type of price action where it's super low volatility, not a lot's moving, but we're just continuously kind of taking out those highs. How do you guys manage that, and how does the distributions kind of look differently when that's kind of happening in the market? Because I know, that's generally happening on S&P and QQQ, but still sometimes on these individual names that you guys have products on, you'll see this slower melt up price action that I'm talking about. So I'm curious if that still benefits you guys, or if the lower volatility just kind of hinders things.
Does this feel like a low volatility environment to you? I mean, the VIX
No. Right now, I know we're in high. I just mean that's what I mean. Like right now, we're in high volatility. I'm curious more of how things run in lower volatility.
So if you have a low volatility environment and things are just grinding higher, there will be sort of products inside the family that are going to do a whole lot better than others. Most of sort of the top tier single name options income ETFs, that's almost an ideal situation for many of those because the stocks aren't ripping around. You can sell some upside call spreads, you're long the underlying, and you're kind of chugging away. Are you going to get really exciting performance from 1 week to the next? Are you going to see enormous distributions from 1 week to the next? Not necessarily, but what you could get is some relative outperformance to the underlying stocks. So I'll just look at one of the bigger funds sort of as an example. If you take a look at NVIDIA, since the beginning of the fourth quarter of last year and through earnings this year, stock didn't do a whole heck of a lot. First of all, before they announced earnings, it was almost flat. Let me double check exactly what the numbers were. So we might as well talk with a little bit of specificity if we can. So we'll just go back to the beginning of the fourth quarter of last year. So we'll just use as our start date. We'll think about September 30th, right? So what are the returns for NVIDIA since September 30th through today? It's the total returns, and that total returns and the stock price are the exact same thing for NVIDIA because it's not really a dividend to talk about there. Compare that then with something like NVIDIA. So you're long the underlying asset, or in our case, a proxy for it, just due to the RIP rules. NVIDIA down 2%. NVIDIA up to 0.78% total returns. So that's kind of a good situation. I would actually say you could look to last year. Look to last year and say, okay, well, what did the S&P do broadly? Had a great year. Relatively low volatility, I'd say, other than let's pull that Liberation Day excitement out of the mix. But excluding all of that, I think that was kind of the market you were describing, right? Would you agree? Last year? Just a question for you. Would you say that last year would, at least in the back half of the year, is kind of the market environment you're asking me about?
Yeah, absolutely.
Last half, all the way up until like beginning October, there was a few stretches there where, well, I was actually making a lot of money last year because I was like, oh yeah, we're up. This is cool. We can be more aggressive. And then, when the musical chairs stop, then, we get into all the trouble and lose all the money.
Yeah. Okay. So then a good example would be, okay, well, how does something like a Biggie do in an environment like that? Biggie's total returns were, I think, for the full year 2025, about 100 basis points higher than the S&P. Kind of ground out, I think it was like a 4.5% share price appreciation for the year. And the rest came out in distributions. And, if we figure that CPI is an understatement of what real inflation looks like, that's a pretty good situation. You basically held steady in real dollar terms. Let's just call inflation 4.5%. Maybe it was a little bit lower, but that's a bit of a sweet spot. So it's a situation where you're going to see good relative performance for an options income structure relative to the underlying assets. It's an environment where you're probably going to see the share price of the ETFs remain fairly stable, which is, something that's always nice for people who have never seen anything but a Yahoo price chart and they don't know how to do a total return calculation. So, that it's nice if the share price basically holds in there or appreciates a little bit, and you'll get some, fairly consistent distributions. You're not going to get the eye-watering ones, though. You're not going to get, distributions like, like Misty saw at, the beginning in, basically 2024, really high volatility, those really eye-watering numbers. So it's there's benefits to both. I mean, I actually would, for my purposes, we try to accumulate assets. We're a asset manager. We like it when things just sort of grind higher. It gives you less to have to explain about what these funds do when that happens.
It's so nice when these just kind of grind higher. Honestly, same. As a YouTuber that it has to explain this stuff, like, he can't. I haven't really been talking about it because it hasn't been doing well, but also there's nothing to say about it because there's nothing for them to do because the market's kind of, volatile. And volatile doesn't mean it's going down, but these risk on assets, when people are not feeling risky, not going to do too hot. But just because I don't talk about it doesn't mean I don't think about it or I don't own it. But you can't expect these funds to do well in every single environment. But yeah, we all would appreciate just like a long, slow, low vol grind. Even though we get paid for volatility, it just feels better to look at your portfolio and say, like, I'm up $100 today and I got paid 30% distribution and my portfolio is still holding steady and going up every day. Not like every single day, but just like in general, not for like months at a time, being like, am I going to be able to eat this month? Am I going to earn enough money this entire month to exist? I don't know. So, I think everybody prefers the not low volatility, just like lower volatility, generally up and to the right. That would be great.
Because you're not trying to make an explanation for what the underlying is doing, what the distributions mean for your total returns. It just gets a lot messier to make those explanations when people are looking at a price chart but didn't actually add up how much money was truly made or lost. So I'd much rather that. And this is an academic thing too, which I'll just...
Also, when it goes on long enough and there's volatility and you have the price erosion, your distributions go down, even if the distribution rate is not, it's not static, the distribution rate, but eventually the distributions will go down. So I like it when the price appreciates because over time, if the yield is static, that means you'll get more money over time. That's the point of all of this.
Leave all of these options income ETFs out of it for just a moment and just think about options income strategies in general and the volatility risk premium. What's the volatility risk premium? The volatility risk premium is sort of a measure of the price of options relative to the volatility of the underlying. So if you imagine that an option on an index is priced at 15 volatility and the index realizes 10, you have a volatility risk premium of 5, right? So it's the difference between implied and realized volatility. One of the things that a lot of academic work has suggested is that the volatility risk premium can actually expand in very low volatility environments. And that doesn't probably sound right when people are thinking about, well, don't I want to sell options when prices are high? And of course, high is a relative thing. High is how much higher it is than realized. And the reason that the volatility risk premium can expand when the underlying is just grinding very steadily. You can imagine if, every month it was up 60 basis points. So not really shooting to the moon, 7% annual total return for the underlying equities. Why would the volatility risk premium expand? And the reason is because people don't like to sell options so terribly cheap. No one wants to sell 5 vol except for Nick Leeson. Nick Leeson, by the way, was the guy who blew up Barings Bank on the YMAX many, many years ago. And he sold the Nikkei down to an implied vol.
Not Michael Coe shit talking someone 5 minutes before this ends. But yeah, selling for $5 is like just not worth it. I do it for SoFi, but I do it really out of the money for SoFi, even in the I'm not looking to make a ton of money on my SoFi options. I just want to do it because I can. So yeah, I don't want to blow up my account.
volatility of 4, believe it or not. So what happens is options prices drift lower, but only to a point, and then nobody's really willing to sell them below that. And contrarily, when things get really wild, they get really choppy. Maybe you wake up on Monday and a war broke out over the weekend, and the market
Just hypothetically, not like that would ever happen in real life.
It just moved 3%. Well, a 3% move is a highly volatile event. If you extrapolated from that and you said, well, what should the volatility be if we saw 3% moves on average? It would be astronomical. But the options aren't going to go there. Why? Because investors realize that was a knee-jerk reaction and that there's going to be some reversion back to the volatility process that the markets typically observe. Maybe it's going to be generally higher because there's a war going on, but it's not going to stay at 80. And so what actually ends up happening is that the options premium can be slightly lower than the realized volatility. And then you're going to see relative underperformance to the underlying assets, possibly, if you're in an options income strategy. So, I think that's the interplay that people should be thinking of. And also as investors, as traders, you always have to kind of take that same step back and say, all right, is this a temporary blip? Is this an intermediate environment that we're dealing with? Or is this a real long-term problem? Now, if people traded options.
Yeah, so whenever the market's down in the morning, I go into Perplexity on my phone and I say, why is the market down today? And then I say, is this a long-term trend? And at some point, Perplexity is going to be like, I can answer more than just those 2 questions, right? That's what happened when I had a Google machine. The only thing I would ask it is, what's the weather like today? And after a few months, he was like, I can play music. I can be, attached to your house. I can do so many things besides just tell you the weather report that you can look up on your own. And I was like, okay, thanks, Google. What's the weather like today?
If we were doing options income overlays on private credit funds, you would see a very different volatility surface right now than you did 24 months ago. But in equities, that's not really what we're seeing.
Agreed. Well, some really great thoughts, Michael Coe. Always appreciate having you on. And I threw the link up top, or the post up top, that you guys made on the YieldMax ETFs account of the live stream for tomorrow, and for people to ask questions in the comments. So again, if you guys have questions, throw them in the comments there. And tune into the stream tomorrow. It's the first one, right, Michael?
It is. It's the first time we're going to do that. And as I mentioned before, get the questions in, get them in early so we can have some time to kind of get the pictures and charts or tables or whatever it is your question might warrant put together ahead of time. And I don't know how many questions we're going to get, so I don't know whether we're going to get to some or all, or whether we're just going to end up dealing with a couple of questions and shooting the breeze for the last couple of minutes. But really appreciate the time and attention of everybody in your audience and the thoughtful questions we always get. And if you want to dig into it any more deeply, please fire off a question or a comment to the YieldMax ETFs X handle, and we'll try to address those in greater detail outside of market hours, so that way all of you can really focus on what you guys have to say in the middle of the trading day when you're trying to pull the trigger on stuff.
Yeah, I'll definitely try and tune into that. I love that it's after market hours, so I should be able to, and everybody else in the audience should as well. Bring your questions, throw them in the chat of that post that I threw up top, and wish Michael Coe good luck on the new live stream. I'm stoked. You guys are doing it every Thursday, right?
That is the plan.
All right.
Awesome. We'll see how people engage with it, and we're going to take people's feedback, try to figure out what we can do better. Again, this is, it's a funny thing. We talk about transparency, and we're happy to take questions, as we do in this space all the time. But transparency means you can see, and what we're doing is we're telling, but we're not showing. And so it's going to be both show and tell. That's the whole idea.
I love it. Well, good luck to you. I hope you guys have a great first stream. I'll try and tune in myself and be in the chat. And I urge everybody in the audience to do the same. So we'll see you then, Michael Coe. Everybody that joined us on this conversation, CryptoFit, Dividend Degens, the YieldMax account. Make sure you guys in the audience are following these.
Okay. That was very long. Also, I'm sorry that this wound up being a 2-hour video, but not that sorry. In too long, didn't read fashion. 1, don't go all in on STRC. Whatever allocation you have, just make sure it's, proportionate to your portfolio and that you actually believe in strategy and that's an actual thing that you want to do and you're not just like knee jerk trying to get into it because everything else in the market is crazy. And then YMAX is going to be interesting. It has a different feel to it than Biggie. So Biggie could wind up being like a bigger like portion of your portfolio because it's supposed to be, at least in theory, like a spicy S&P 500. So similar, but hopefully just a little bit better gains than the S&P 500. YMAX hopefully will have better momentum and price action, but we'll see about that. I'll just continue to cover that. I'm still undecided about getting back into Ulti. Maybe it'll just be like a beginning of next year thing type of thing. And then they talked so much about STRC that it's hard to talk about anything else. But yeah, we all prefer those type of environments where it seems like everything is going up, even when the volatility is a little bit down, which means it was a little bit tough last year when I kept putting things up and the price isn't going down, but the amount I'm getting paid keeps getting down. So I have more shares, but I just getting paid like the same, and it just feels like I'm not I'm not making any progress. But eventually it will be progress. So just like have faith that it's going to work out in the end and keep DCing and stick to your plan. So I'm hungry. It's almost 1 p.m. What are you having for lunch today? And I'll talk to you later. Bye.